Thanks for your interest. I'm glad you're digging a little further into this infinite banking process here. Now, it might be kind of hard to get your arms around it. Let's give you a day-to-day example. When was the last time you bought a car? Chances are you went to the bank, right? Well, there's other ways that you can do it. Russ Morgan is with us now. He's going to show you step by step the difference between the infinite banking process and some other ways that you can purchase a vehicle. Russ?
You're right, Scott. Everyone does buy cars, and over their lifetimes they can spend hundreds of thousands of dollars in interest just in the way that they finance them. Today we're going to look at some strategies that can actually recapture that interest and put it back in their pockets. The example we're going to look at comes from a book, Becoming Your Own Banker by Nelson Nash. This book is a crucial part of understanding the infinite banking concept and how to apply it. We're going to be looking at page 45 where Nelson Nash compares two different methods of two 21-year-old twin sisters who are going to be purchasing cars and recapturing the interest that otherwise would have went to the finance companies. One sister is going to be using a traditional financial product such as a CD with an after-tax rate of return of 4%. The other sister will be using a dividend-paying whole life policy with a specific design to enhance its cash value buildup. In order to do banking, they both must capitalize, and they do so by depositing $5,000 per year for 7 years into their respective accounts. They meet annually to compare the results, and after the first year, the CD sister has a significantly higher percentage of money in her account. The reason for this is that the insurance sister has had to start a business from scratch, which is her whole life policy, and pay all the upfront cost. The bank that the CD sister is using has already paid these costs in order to have use of the money that the CD sister deposits. They continue to meet each year, and as you can see, the CD sister continues to have more money. Starting in year 8, they decide to purchase a $10,550 car every 4 years. They each withdraw money from their respective accounts and agree to pay themselves back $3,030 per year, which is just $260 a month. After paying back the second car, which is year 15, you can see that the CD sister now has less than the insurance sister. From this point on, the margin will continue to grow in the favor of the insurance sister account. This happens because the insurance policy becomes more efficient every year it is owned, and the interest and the dividends paid accumulate on a tax-deferred basis. We will fast forward to year 44, where we will see after the purchase of the 10th car, the insurance sister has almost over $365,000 more. They purchased their last car in year 48, and at its payback schedule, the CD sister has $258,000 in her account, while the insurance sister has over $964,000 in hers. The difference between the two is over $705,000. This number represents not only how much more the insurance sister made, but it also would represent how much the stockholders of the bank the CD sister used would have made if they compounded their growth over a tax-deferred basis. If we summarize real quickly, you can see that each sister contributed $35,000 in the first 7 years and paid themselves back $133,320 over the 11 car purchases, giving them total contributions of $168,320. They each withdrew a total of $116,050 for the 11 cars, giving them a net contribution of $52,270. If they both took retirement income of $50,000 each year starting in year 52, the CD sister's account would be empty after 5 years and 8 months. However, the insurance sister could continue to withdraw $50,000 per year and her account would still be growing. Finally, did banking work for them? Sure. For the CD sister, she put in a net $52,270 and was able to purchase all her cars and still withdraw over $283,000. But how did banking work for the insurance sister? Well, she too put in a net of $52,270. However, at year 64, she's been able to withdraw $650,000, plus she has over $1 million in cash with a net death benefit of over $1.3 million.
All right, I'm admitting again, I count with my fingers. I'm better with my toes adding into this here. But it sounds to me like we had two sisters. They bought the same number of cars through the years, right?
Correct.
Each month they paid out the same amount of money.
Correct.
Right? Okay. And then when it was all said and done, one had $200,000 or something like that, which is not bad, but the other one had $600,000 and it was still growing?
Correct.
So the only thing that was really missing here was the bank. I bet you're curious now, huh? Order the book. It's just 80 pages. It's going to give you a lot of information. You can order it right here on the website. If you got questions, the telephone number is there as well. What are you waiting for? Why are you still giving money to the bank when you can give it to yourself?